Okay, so for you listening in Kenya, you know that common advice, build wealth through stocks and bonds.
Yeah, the standard playbook.
Well, it might actually be steering you a bit wrong.
That's a really critical point we need to unpack because, what works well in, say, the US or Europe,
hmm
it doesn't always map perfectly onto the Kenyan reality.
Exactly. So today we're doing a deep dive into why that typical Western investment model,
Mm.
well, it might not be the fastest or surest path to, real prosperity for Kenyans.
hmm We're looking at insights, really, from a Kenyan viewpoint,
Hmm.
one that sort of challenges that conventional wisdom about getting ahead financially.
Yeah, so our mission today is pretty clear. Let's try and understand why here in Kenya, focusing on generating income actively,
Yeah.
building your own businesses, why that might be a much more direct route to wealth compared to just relying mainly on the stock market or bonds.
Okay, let's get into it.
Right. So first up, this common advice, you hear it all the time, don't you? Stocks and bonds, that's the key to getting wealthy.
Oh, absolutely. It's everywhere in the global financial conversation, often pushed as like the foundation of smart financial planning.
Precisely. But okay, let's ground this in Kenya. The Nairobi Securities Exchange, the NSE. Look, it definitely has some strong performers. You mentioned Safaricom before we started recording.
Safaricom's a great example, yeah.
Yeah.
A real powerhouse. Some investors have seen fantastic growth there, no doubt.
But, and this is a big but, isn't it? For many individual investors outside maybe those huge success stories, the experience can be quite different.
That's right. A lot of people investing on the NSE might see their money just sit there
Right.
or even go down. It's definitely not an automatic win.
So it's not quite the straightforward wealth generator people might imagine.
Not necessarily, no. And there are factors like market liquidity, how easily you can buy or sell shares, and the volatility of the price swings.
Right.
These can be quite different from more, let's say, mature markets.
Okay. Then you've got the other side, the supposedly safer options, like Kenyan treasury bonds.
Right.
They advertise returns, maybe 9%, sometimes up to 13% per year. Sounds pretty good on the surface.
It does initially. Very appealing. But, and this is crucial, you absolutely have to think about inflation and taxes.
Uh-huh.
Once you account for those, that real return, what you're actually gaining in purchasing power, well, it often drops quite a bit, maybe down to something like 4%.
4%. Okay. So this brings up a really important question for you listening, right? If you're trying to genuinely build wealth, maybe starting from scratch or with not much, is a real return of, say, 4% truly wealth building?
Or is it more about just trying to keep the money you already have from, well, losing
Leaving.
value, capital preservation, essentially?
Exactly. Is it moving you forward significantly or just treading water?
For someone with big goals, starting with limited capital, that kind of return, well, it might just not cut it. Not for building significant